Nvidia sells the chips powering the artificial intelligence boom. But Nvidia is also investing billions of dollars in the companies buying those chips. It is supporting the buildings where those chips will run. It is guaranteeing some partners' leases. It has committed billions to cloud services. And in one of the most extraordinary proposed deals in technology history, Nvidia said it could invest up to $100 billion in OpenAI as OpenAI deployed data centers filled with Nvidia systems. The money leaves Nvidia, moves through the AI industry, and can eventually return as revenue for Nvidia. That does not prove the demand is fake. But it creates a question worth trillions of dollars. How much of the AI boom is independent demand, and how much is being reinforced by the company profiting most from it? To understand why this matters, start with a sentence buried inside Nvidia's own annual report. In fiscal 2026, Nvidia invested $17.5 billion in private companies and infrastructure funds. The company then added an unusually important detail. Those investments included AI model makers that purchase Nvidia products, either directly or through cloud providers. Read that again. Nvidia is not only selling the most important equipment in the AI economy. It is placing money inside the businesses creating demand for that equipment. That can be smart strategy. It can help promising companies grow faster and expand Nvidia's ecosystem. But it can also make the market harder to read. Because when a supplier invests in a customer, and that customer uses the money to buy more of the supplier's products, revenue can look like pure outside demand even when the relationship is partly self-reinforcing. The clearest example is CoreWeave. CoreWeave began as a cryptocurrency mining operation. It later transformed itself into a specialized cloud company renting access to enormous clusters of Nvidia processors. Its entire pitch is built around the shortage at the center of the AI boom. Companies desperately need computing power, and CoreWeave can provide it. Nvidia was already a major shareholder. Then, in January 2026, Nvidia invested another $2 billion in CoreWeave at $87.20 per share. The two companies also announced a deeper partnership. CoreWeave planned to build more than 5 gigawatts of what Nvidia calls AI factories, while adopting multiple generations of Nvidia computing, networking, storage, and processor technology. So Nvidia invested in CoreWeave. CoreWeave used Nvidia infrastructure. And CoreWeave sold access to that infrastructure to AI companies. One of its biggest customers was OpenAI. Under a disclosed agreement, OpenAI committed to pay CoreWeave up to approximately $6.5 billion for cloud computing capacity through May 2031. On the surface, these look like ordinary business relationships. But now look at CoreWeave's finances. By March 2026, CoreWeave reported almost $25 billion of debt, more than $10 billion of operating lease liabilities, and an accumulated deficit of $3.4 billion. Some of its debt carried effective interest rates as high as 15%. CoreWeave said it had generated significant losses and negative investing cash flows while continuing to build its infrastructure. That does not mean CoreWeave is doomed. Fast-growing infrastructure businesses often borrow heavily before their assets generate their full return. But it means the system depends on several promises being kept at once. CoreWeave must secure financing. Its data centers must open on time. Customers such as OpenAI must continue paying for capacity. AI demand must remain high. And the expensive Nvidia hardware inside those facilities must produce enough revenue before newer chips make it less competitive. Now add another layer. In September 2025, Nvidia and OpenAI announced a letter of intent for OpenAI to deploy at least 10 gigawatts of Nvidia systems. Nvidia said it intended to invest up to $100 billion in OpenAI progressively as each gigawatt was deployed. Think about the structure. OpenAI would build enormous data centers using Nvidia systems. Nvidia would invest in OpenAI as those systems were deployed. OpenAI would then need millions of Nvidia processors and the surrounding equipment. Again, this is not proof of fraud. The announcement was a proposed strategic partnership, and Nvidia later warned that there was no assurance a final investment agreement would be completed. But the proposed loop was impossible to ignore. Nvidia could help fund one of the world's largest buyers of Nvidia technology, with the investment increasing as that buyer deployed more Nvidia systems. And the pattern does not stop with equity investments. Nvidia disclosed $11.4 billion in investment commitments as of January 2026. It also disclosed $27 billion in multi-year cloud service commitments, expected in part to support its own research and development. And it guaranteed up to $3.5 billion of partners' facility lease obligations in exchange for warrants. If those partners default, Nvidia could face exposure to leases on the land, power, and buildings supporting AI data centers. In other words, Nvidia is not standing outside the AI infrastructure boom selling shovels. It is investing in the miners, reserving parts of the mine, supporting the buildings, and sometimes helping guarantee the land beneath them. That is the controversy. The same company appears at multiple points in the financial chain. It supplies the processors. It invests in model developers. It owns stakes in cloud providers. It commits to purchase cloud capacity. It supports some data center leases. And it earns more revenue as all of those companies expand. This can create a powerful flywheel. More Nvidia investment helps AI companies grow. Growing AI companies need more computing power. Cloud providers borrow more money and build more facilities. Those facilities buy more Nvidia systems. The new capacity allows AI companies to train larger models. And the excitement attracts more capital, beginning the cycle again. When the flywheel is accelerating, it can look unstoppable. But financial loops have a dangerous feature. They can hide which demand would still exist if the financing stopped. Suppose investors become less willing to fund loss-making AI companies. Suppose borrowing costs rise. Suppose companies discover they can run models using fewer chips. Or suppose customers stop paying premium prices for AI services. The weakness would not remain inside one company. A model developer could reduce its computing commitments. A cloud provider could be left with underused data centers and heavy debt. The value of Nvidia's investments could fall. Its lease guarantees could become more relevant. And future orders for Nvidia systems could slow at the same time. This is why the counter-argument matters. Nvidia is not a fragile company using accounting tricks to create the appearance of a business. In its first quarter of fiscal 2027, Nvidia reported $81.6 billion in revenue. Data center revenue alone reached $75.2 billion. Its gross margin was nearly 75%. Those are not the numbers of a company surviving only because it invested in a few customers. There is also real demand behind AI. Consumers, corporations, governments, and research laboratories are using accelerated computing. Nvidia's hardware is central to a genuine technological shift. Strategic investment is also not unusual. Technology companies have always funded developers, suppliers, and customers to expand their ecosystems. The real issue is not whether Nvidia has invented the AI boom. It has not. The issue is whether the financial relationships surrounding the boom are making demand appear safer, more independent, and more permanent than it really is. Because Nvidia's filings show an ecosystem where investment, infrastructure, cloud contracts, guarantees, and product purchases are increasingly connected. Every deal can make sense on its own. The risk emerges when they are viewed together. A supplier funds a customer. The customer signs a contract with a cloud provider. The cloud provider borrows billions to buy the supplier's equipment. The supplier invests in the cloud provider and supports parts of its expansion. Then the resulting purchases are treated as evidence that demand is accelerating. Perhaps that demand will grow into the infrastructure already being built. If it does, Nvidia may have created one of the most powerful business ecosystems in history. But if AI revenue fails to catch up with AI spending, the industry may discover that it was not a collection of separate companies making independent bets. It was one interconnected machine, with Nvidia's money, technology, and influence running through almost every part of it. The AI boom may be real. But real technology can still produce a financial bubble. And the most important question is no longer who is buying Nvidia's chips. It is who gave them the money to buy them. For more investigations into the companies controlling money and technology, subscribe to Money, Lies and Power.